What have I told you? There's a trading strategy out there that its creator claims is not only foolproof, but has also made them over $1 million? Yeah, you heard that right. Today we're going to break that exact strategy down piece by piece. And here it is, straight from the source. I have personally made over $1 million. I mean, that's not some hypothetical backtest. That's a huge, bold claim. And it immediately makes you wonder, okay, how? What's the secret sauce? Well, believe it or not, it all comes down to a really simple 3-step process. So that's what we're going to do in this explainer. We're going to pull back the curtain and look at each one of those steps to figure out what really makes this thing tick. Now, the creator makes one thing crystal clear. Even though it's simple, you can't skip a single step. Each one is absolutely critical. Get one wrong, and the whole strategy just doesn't work. So let's dive in. Okay, step 1. Now, this is probably the most important part of the entire strategy. And get this, it has nothing to do with your entry or exit. It's all about finding the right market environment to trade in. This is the foundation for everything else. And that's because this strategy only works in one specific type of market. The whole idea is that the condition you're trading in is way more important than the actual entry signal. Think about it, right? If you have a strategy designed for a choppy sideways market and you try to use it in a market that's just rocketing straight up, you're going to get destroyed. It's about using the right tool for the right job. So let's look at the two big differences. On one side, you've got a trending market, prices just making higher highs, like it's climbing a set of stairs. This strategy says stay away from that. But on the other side, you have a ranging market, prices just bouncing around sideways, like a ball trapped between a floor and a ceiling. That is the sweet spot. That's the only playground this strategy is designed for. Okay, so how do you actually spot one of these ranging markets? Well, the source gives us a pretty simple checklist. First, just look at the last, say, 4 or 5 hours of price action. Is it generally just moving sideways? And second, are the moves up and down big enough that they're retracing or correcting more than half of the previous move? If you can answer yes to those, then chances are you're in the right spot. All right, so you found the right condition. That's step 1 checked off. Now for step 2. Where inside that range do you actually look to place a trade? And to understand this, the creator uses a really cool analogy. Think of the price range like a big elastic band. You don't want to trade in the middle where it's all loosey-goosey. No, you want to wait for that band to get stretched all the way to an extreme high or an extreme low, because that's where all the tension is, right? And that tension is what creates that powerful snap back toward the center. So this gives us a super simple rule of thumb. Looking for buys? You only look in the lower half of the range. That's it. Looking to sell? You're only hunting in the upper half. You basically ignore everything happening in the middle. The middle is just considered messy, unpredictable noise. And defining these zones couldn't be easier. You just take the entire range from its absolute high to its absolute low, and you draw a line right through the middle at the 50% mark. Boom, that's your dividing line. Everything above it is your sell zone. Everything below it is your buy zone. Simple as that. And for anyone who wants to get a little more granular, the source offers a pro tip. You can refine your zones by looking at where the hourly candles are closing. Those closing prices can act as more precise levels of interest inside your broader buy or sell half. Okay, here we go. The final piece of the puzzle, step 3. So you've got the right condition, you've picked your spot in the upper or lower half, but how do you know when to actually pull the trigger? You need a confirmation. You need that go signal. And this is the big one, isn't it? This is what separates just watching the market from actually being in the market. What is the exact moment you stop waiting and start trading? The entry trigger is something called a shift in market structure, and you're looking for it on a really low time frame, like the 1-minute chart. So let's say you're looking to buy. Price is making these little steps down, lower low, lower high, lower low, and then bam, it makes one final low, but then immediately shoots up and breaks the last little peak it made. That tiny U-turn right there, that's your signal. That's the confirmation that the sellers just ran out of steam and the buyers are starting to take over. But here's the key. You don't chase it. You don't just jump in right after that break. The strategy says you have to be patient and wait for the price to pull back, to retrace to the 50% level of that little confirmation move. That is your entry. It's all about getting in at a better price, kind of like getting a discount right after you've confirmed the trend is changing. So there you have it, the 3 steps.
condition, area, and confirmation. Let's put it all together now and look at an example from the source to see how this plays out in the real world.
Okay, so check this out. First, step 1, condition. The trader spots a bullish range that's been forming for over 8 hours, so they know it's a good environment to look for buys. Then, step 2, area. They zero in on the lower half of that range, waiting for that elastic band to stretch down to a discount price. And finally, step 3, confirmation. They zoom into the 1-minute chart, wait for that little shift in market structure to happen, and then bam, they enter right on that 50% pullback. It's a textbook execution of all 3 steps. So let's just recap the core logic one more time. It's really simple. Step 1, make sure you're in a ranging market, not a trending one. Step 2, hunt for buys low and hunt for sells high. And step 3, don't do anything until you get that clear shift in structure on a tiny time frame. That's the whole shebang. And you know, this really brings up an interesting question. The creator calls this a foolproof system. But when you break it down, the steps are, well, they're pretty simple, right? It makes you wonder, is the secret to trading some crazy complex foolproof system? Or is it just having the incredible discipline to follow a simple one perfectly over and over again? Something to think about.